Yo, Steve Palise here. How you structure the finance on your commercial properties is one of the most important parts of your investment strategy. Before I get started, I should point out that commercial and residential property loans are completely different. Residential loans are usually principal and interest or interest only and are over 20 to 30 year periods. Commercial loans have more variety and will usually be the length of the lease or 10 to 20 years. There are different types of commercial loans, and that's what I'll be running you through in this video. First up, we have full documentation loans. A full doc loan is the most common type of mortgage in Australia. You'll have to provide more information for this than any other loan application, including details of your income, asset base, outgoing, and your debts. Second on the list are no doc and low doc loans. If you're self-employed, a contractor, or even a professional investor, it's usually more difficult to provide all the financial documents to meet the lender's requirements. A no doc or low doc loan requires less information about your assets and liabilities, and the rules are more relaxed compared with a full doc loan. But the lender will then ask for a larger deposit, usually 35%. Plus, their interest rates are likely to be higher. Next up are lease documentation loans. Lease doc loans are excellent for investors who have several properties and are reaching the limit on their loan serviceability, meaning they can't service another loan with their personal income. For a lease doc loan, lenders solely look at the asset and the tenant involved to determine a borrowing amount based on the property's net income. The fourth type of loan are lines of credit. A line of credit allows you to use equity from your principal place of residence or investment property. It's an ongoing agreement between you and your bank that gives you access to a predetermined amount of credit whenever you need it. With a line of credit mortgage, the money you borrow is usually secured against your equity in that property. Think of it like a credit card. You have a pre-approved credit limit and you can borrow as much of this as you want as long as you pay interest on the outstanding balance. But because one of your properties is being used as equity for another, if your investments go down in value, you risk losing both properties. One less publicised but quite common avenue for obtaining finance for a commercial property is vendor finance, the last loan on my list. As commercial properties usually require at least a 30% deposit, when you add on purchasing costs, the capital required for an investment can be quite high. With vendor finance, the vendor or seller makes money by selling their property to a buyer using a lease option or an installment contract to provide all or part of the funds. So basically the buyer borrows funds from the seller to buy the property. There you have it. As you can see, commercial lending is quite a lot more complicated than residential lending. If you need guidance or have any questions, please drop them in the comments below. If you know of someone looking into commercial property as a form of investing, make sure you share or tag them in this video. This is Steve Palise. Thanks for watching.